So thank you. So today's topic is how I select options to trade. So I receive emails. How do you select options? So based on this common questions, I created a little presentation. I'll show you how I select options. So maybe you get some idea when you are selecting the options to trade. It's not teaching you the technicals here. So it's not a technical course. There is no technical charts here. It's not I can teach you in half an hour and then you go on and make a lot of money. That's not going to happen in this half hour. But I'll give you the ideas when you, if you're already trading options, and based on this, what I'm going to teach you, maybe you can get some, aha moment. So it's all about aha moment. I'm always looking for aha moment. I drive 5 hours just to get some aha moment to meet with my mentor. So 5 hours, 2.5 hour one way, 2.5 hour, and a half hour meeting. And then during that half hour meeting, I get some aha moment and then I come back. So there is a difference between talking to someone and getting, uh, some hint or, just call that person and he may give you something, or going in person and meet with that person face to face and look into his eyes or her eyes and get something out. So I do that. Well, we cannot all come. There are 72 people. We cannot look at each other, but I'm going to teach you something. Maybe you get some idea that that's what it is. Some aha moments. So this presentation is about selecting the options. So long time ago, you may have heard talking about Bruce Lee. So when I like someone, I talk about that person a lot. So I love Bruce Lee. I think he changed my life in some way or the other. Growing as a kid, I used to watch Bruce Lee. I go on a YouTube, listen to his, saying some videos, some lessons there. So when I was learning stock options, I was learning the wrong way. So that's one thing. I was learning to trade options. That's what the traders do. They want to learn to trade options without learning about themselves, about the market, about the selection of the stock and what else is going on. They just want to find some guru to teach them a half hour how to select option and trade. So that's what I was. I was told to trade options and I did not know anything. So I lost $2,000, then I lost $10,000. So then I met somebody and then he gave me this advice that Noshi, don't learn option first, learn stock, don't learn commodity, don't go about learning here, there, this. Learn to read the chart first. So Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So just practice one kick 10,000 times, whatever is that kick. So, and one time, I give you another example. When I was a kid, my uncle, I grew up with my maternal uncle for 7 years. He brought me up. He was a one-eyed man, very thin. And then one day I was walking with him and he suddenly stopped and he asked me to look at him. So I look at him and then he raised his fist, just like Muhammad Ali. He raised his fist and in front of his face, in front of my face. And then he said, look at this fist. So I look and he said, do you see this fist? When you, first of all, you don't uh, go into physical with any person. He knew that I will not grow tall, and he knew I will not become a muscular guy. I'm a normal guy, below average height. So he knew that I was very studious and I'm not into this. So he said, Noshi, don't get into fight with the muscular guy or with the big guy or with any guy. But if it so happen that you are cornered in a room or somewhere with the guy who is twice as big as you and he is beating you, you have one chance to survive and get out of here. And then he raised his fist again and he said, see this fist? It should land on this guy's face so hard that he crumbled in front of you. And that is the chance you will um, get to survive and run away. So it has happened to me. I got into that kind of situation. So I survived. So the same concept Bruce Lee is saying, to practice 10,000 kicks one time. So we tend to practice 10,000 things only one time, little here, and we don't achieve anything. I've been trading for 15 years and I've been doing same thing again and again and again. So I'm just practicing 10,000 one kick 10,000 times. So Bruce Lee changed uh, my perspective, or the way to create wealth. Create wealth. I've seen people doing 10,000 things here, there. They do little things. A little bit make money here. Okay, let's do this. Make some commission here. Maybe a little bit here. Like people say, hey, if you send your members to my brokerage firm, I will give you commission. I say, no, I cannot do that. Hey, if you let your members trade Forex with us, you will make money from the spread. No, I will not do that. Hey, can you market this letter for us? If they open this letter, we will give you the money. I said, nope, I don't do that. So these are little things. I don't do that. What I do, I focus on a big thing. So you need to focus on a big thing where the long run you will make money. Don't go little things. So I don't do little things. I rather die and do big thing. So same way, when I was learning, my mentor, his name is Chief, a 78-year-old person living very close to me near Anaheim. I lived in not 40, 50 miles. So one day he said, Noshi, you need to, I said, Chief, how do you trade all this and make money? I don't see anything in the chart. So he said, dinosaurs. These are dinosaurs. The big boys are dinosaurs. You need to read. Dinosaurs print, make a print on the chart. You need to identify those dinosaurs. It's not just volume. If you think dinosaurs are volume, then you are wrong. I've seen newsletters sending, we will send you the trade which has a volume. So wrong. Volume, that could be the last print. When the volume is high, there's nobody left. If everybody has bought the mangoes in the market because tomorrow is the festival, so there was a lot of volume, and then at nighttime I say, oh, a lot of people were buying mangoes. I will go tomorrow and sell mangoes. Nobody is in the market. There's nobody buying mango because they bought the mangoes already to the day before yesterday. So if there's a big volume, maybe everybody bought, or maybe there's a large huge volume, maybe everybody sold. So dinosaurs definition is not the big volume. So this is wrong. When people say dinosaurs are big volume, there's something else. The way they are behaving, the way they are coming at the time when we expect the market will go down, and they are buying it. When we expect the market to go up, they are selling it. So something is with the dinosaurs. So early on I started to learn how to detect the dinosaurs. So it's all about the twist and turn in the market. Here's a little twist. Here's a little. If you think it will go down, and then it's not going down, and why it's not going down? It's going up. If you think it's going up, why it's not going up? It's going down. What's going on? So all this little twist and turn. These are the big boys. All the institutes. Imagine the big boys. Who are the big boys? The wealthiest of the wealthy firm. The people, for them, there are trillions of dollars they have. They are investing institution, pensions, a hedge fund, the high frequency guys. All these are big boys, and you are trading against those big boys. So you are trading against those dinosaurs. So another, people come to trade with $2,000 or $1,000. Open an account with the Robinhood, and I'm going to trade. I'm going to make money. Yes, you can. Maybe 1 or 2 day, 3 day, 4 day. You can take 2,000 to 5,000, $6,000. Eventually it will become zero. So you're not dinosaur. You're coming with $2,000. You can get lucky, but the luck will stop. So dinosaurs have a trading capital like a China wall. Have you seen a China wall? So the China wall is as thick. So if you throw tennis ball on the China wall, the China wall will stay, there. But yeah, if you throw cannonball, if you are Genghis Khan and you start throwing the cannonball, the China wall will break. So the retailers, they bring their capital, and then when they get tennis ball hit on them, they crumble. So they're not dinosaurs. They don't have a capital like a China wall. So all that is a mistake. Traders make mistake. They don't prepare anything. They just come every day and try to find. I do the work. So evening time, 4 to 5 hours is spent. So 6, 7 hours is spent during the day. If you ask me how many hours you work a week, so I tell you I work 100 hours. So it's not like I'm not those guys where say only work 2 hours and make this much money from stock trading. Maybe, but I'm not that 2 hour kind of guy. I say I work only 2 hours. I'm not. I can't. I don't know how 2 hours, just 2 hours work. Maybe I can make money 1,000, $2,000, but that's not my 1,000, 2,000. I am into making millions. So it's not 1,000, $2,000 work just 2 hour and make money and then go on the beach and have two girls, one on this side, one on that side, have a photo. Maybe I rent a tour jet, two-seater plane and then take pictures. No, those the real guys, they are not doing that. If they have made enough money from the stock, then they are running something else. They have other things to take care of related to increasing the wealth. So do the work. I do the work. I have all these baskets. So I'm telling you what I do, and I will explain to you in the end how I select options. So I have a basket of stock, and I'm constantly improving and fixing my basket because I don't want to miss the gems. These are all gems. These will make me money. So I have a hardcore stocks. In the beginning, I had 8,000 stock. I went to some source and I downloaded all the stocks, like all the craps. So 8,000 stocks. So when I asked Chief, 8,000 stock, how I'm gonna handle all these? So he laughed. He said, "Okay, make some criteria and reduce it." So I reduce it based on the volume, average volume, 500,000, 400,000, 1 million per day, ATR, such and such, beta, volatility, if they are optionable, not optionable. So always on the news, earning always coming up. People watch their earning. There's always some product announcement, something going on, some competition going on, some restrictions getting imposed. Even the president of the United States is talking about that sector. So those kind of stocks. So if those kind of stocks they go into hardcore stock. So they're about 165. But then not only 165 enough, then I have a 250 stocks, other stocks, core stock. So each indices, the baskets, 500 here, 30 here, 400 here. Not all of them can go into in my for my attention. So pick and choose. Okay, out of Dow Jones 30, I like these 20. I don't like AT&T or Verizon. So I don't, move. They move like 20 cents a day. So I don't want about AT&T and Verizon. So ignore that. Yeah, what I want Goldman Sachs. I want Apple. I want American Express. I want Caterpillar. I want Home Depot. All these stocks. So get these in core stocks. I want Burlington, Ross. All these in the, when you go outside, McDonald's, Jack in the Box, these stock, Panera Bread, these are the core stocks. So technology, AMD, Nvidia, AMAT, all these which are always in the news. And then what happened? Then there is something become big. It was a $5 stock, now it's $10 stock, then it's 15. So it gets my attention. Starting from $2 or $3, it keeps coming because I have in the basket of a small cap. So from a small cap, they become bigger and active. Then I move them to the core stock. So the core stocks are building up. I'm reducing the stock from the small cap because they are getting big, and then some of them are going to non-core. Non-core stocks are those stocks which I need to watch because they are part of the market. I cannot ignore AT&T and Verizon, even though I'm not trading, but I need to see what is there. I need to check GE. So those kind of stocks which are affecting, they are the part of the basket. They go there. I just look at it once in a while, see the overall position. When I'm analyzing the market, I look at it, but I'm not trading it. So it's that a small cap stock when the market is rising, when the small cap stock, the growth stocks, then this basket starts to build up. And they get built up based on the news, based on the fundamentals. So for small cap, fundamental come first, and then come the technical. If the small cap is just a cheap one and it's not doing anything, and fundamentally is weak, I cannot trade small cap. I will lose my shirt. And I remember I bought some coffee stock a long time ago, coffee stock for 20 cents. I bought 1,000 shares, 20 cents. Somebody told me, hey, buy this coffee stock, 20 cents. I said, okay, 1,000 shares. You love buying 1,000 shares. Oh, 10,000, I can buy 10,000. Start thinking about all the money I will make if I buy, max out my credit card and buy 10,000 shares at 20 cents, and then think about all the money I will make when it goes to $25. So I got hooked into that. And that 20 cent stock went into 80 cents. So maybe pump and dump or whatever. So it was trading at 80 cents. I was 400% up. And then I said, no, it will go to $25. And then it went to zero. So when I look at it, it's a zero. So that the small cap is zero trading. So I didn't do any, I just pump and down long time ago. So I learned, so small cap is fundamentally based. So I do a lot of homework in a small cap. I go and select my stocks of all this small cap, fundamental is strong, then create the basket, and then apply the technical analysis. And then I select if there is the option, then I'm or more thrilled because they make me 100%, 200% gain. Then I also need to do the indices ETF, where it is. I was trading a DIA recently. I went long on a DIA about a week ago, and so it was a March call. So DIA, SPY, IWM, TQQ, SMH, and all those gold miners and a gold miner junior, silver, gold, all these are part of the ETFs. So DIA, along with DIA, 2 days ago, I sold my position DIA, market got stuck. So sold DIA, it was a March call. When the market starts to moving, I don't need to, then I see which one has a more potential. Where in the landscape, which one gives me more, looks like will give me more bang for the buck. So out of DIA, SPY, IWM, and like QQQ, 4. So I selected SPY calls. So now I'm long SPY. I I believe the market is going higher. So yesterday the market has given a reversal signal again to the upside. So I do all this analysis. I have to do the work. If you come to the market and you don't know where the SPY, DIA, QQQ is in the cycle, or what is doing, where is the resistance, where is the support, and which one has a more potential, then you may not be able to trade properly, because based on the SPY. So if you think SPY is the one, then you will select the SPY related stock. If you think IWM is the one, then you will select the small cap stocks. Or DIA, if you think DIA is moving higher, then you will go and look the Dow Jones 30 stocks. So all that. And then I have a basket of semiconductor. I have a basket for gold and silver. So I am long in a junior minor. I am long in one of the junior minor. And then inverse ETF. So if so, you need to have traders need to have multiple trading system. So I will give you another presentation, another teaching I am preparing. I taught one about 1/3 one time. Now I've completed the other 2/3. I will teach you. I'll show you through the metrics about the trading system optimization and tweaking, etc., what the traders do and what emotions they go through when they are not, what emotions expert go through when he knows his stuff, and what emotions newbie goes through. So I will show you through the chart, through the metrics about the trading system. So the trading system, we need to have at least two trading system, one for the long side, one for the short side, and ideally one for the sideway market. Let's say but you have, let's say, only one trading system, one way of looking at, because not many traders mentally switch. They cannot read the chart from top to down. They are only able to read the chart. So think about it. If you are aware of this phenomena, maybe you can do something about it. Maybe you just learn the chart to read from the left to right, and you say, okay, somebody teaching you got some learning somewhere, and they teach you to go long only, and they don't teach you to go short. You cannot think about reading the chart which are topping out or putting on the reversal. So you don't have that skill. So it's okay if you don't have that skill. When the market is going down, you are left out maybe 30-40% of the time. So 70% of the time market is trading sideways, 30% of the time market is trending. So whether it's trending upward or whether it's trending downward, so it depends. So if it's trending downward and you don't know, then you are left out. But there is a solution to every problem. So maybe you make a list of all the inverse ETF. So you need to do the homework, find all the inverse ETF which move up when the market is going down. So you say, okay, I only know how to read the chart only one way. I'm good at reading one way, which one is going up. I can't tell which one is going down. So you prepare the chart of the symbols basket of inverse ETF and apply your long trading system. If your long trading system is so good, you will get the long signal on inverse ETF. And these inverse ETFs are going up when the market is going down. So when the market is going down, you immediately switch uh, your basket. So imagine having look at this one, mastering key pattern. Imagine having a trading system, and you have a basket of stocks. So you open your trading system, whatever it is. I will show you what trading system you can have. So you say, okay, trading system, my back blocks. Open it, and then you say, okay, apply to this list of symbols. So you say, okay, apply to my inverse ETF. So inverse ETF, now the system is looking at inverse ETF. And then you say, okay, I want this pattern, I want this pattern, I want this. I'm only looking at this. So you train visually yourself because you work 41,000 hours. You have dedicated 41,000 hours, so now you are a master. So you say, okay, I put 41,000 hours and I'm only looking at this pattern and I'm only looking at the inverse ETF. And because the market is going down and I expect the market to go down further for a week, so this ETF will move. This is not a slight pullback. So sometime you need to master something you need to master, which where you become expert. So again, I give you example of my uncle. One day, so I lived in a small city, very small city where everybody knew. If you are from India, Pakistan, we have a flip-flop called Bata. So chappal, Bata, chappal. So it has a two thing, like it's a flip-flop. So when it gets broken, one side, we go and to the cobbler, and instead of buying a new, the cobbler put a nail or some stitch, and then he fix it, and then you wear it. It's good for another few months. So one of my sandal got broken, the flip flop, the Bata chappal. So he took me to the cobbler. So while he was fixing it, he pointed out. So we call mochi. My name is Noshi, and the cobbler we call mochi. So in fact, my grandma used to call me mochi. She never got my name that I my name is Noshi. She always said, "Hey, is Mochi here?" So mochi means cobbler. So he pointed out towards the mochi, and he said, "Noshi, I don't care what you become when you grow up, but I mean, I don't even care if you become a mochi, but there shouldn't be any mochi like you in the world. So ask yourself, then, are you such a trader that there's no one like you in the world? Do you have some edge? Are you creating some edge in the market like no one else?" So when I was learning, the chief said, "Hey, no, you cannot. I'm buying this book. I'm buying that book. I am a book hoarder. I buy a lot of books. I mean, I buy books left and right. Thousands of books I have, and I read in my library overnight. Change, over the not overnight, over the period the libraries have changed. Sometimes I was in astronomy, sometimes in physics, chemistry, math, all that. Now into trading and all the other topics. So that's what he said, master only few patterns and then apply that pattern to your baskets based on the trading system, based on the market, based on the trading system. Then you select the basket of the stock and then you look for those patterns. So you don't need to master 10,000 things. And listen to what Bruce Lee is saying. So I master few patterns. I don't have to keep on inventing new pattern. Why? Because there may be a very profitable pattern, but it appears only once a year. So it's not a good pattern where it appears only once a year. And if I and it's 100% chances of making money, even if it's 100% chance. But if I miss that, then I'm again waiting for 1 year. I rather master those which appear again and again. So I listen to his advice and master the pattern. Then so there are many ways, there are many techniques to look at the trade. I mean, the trade is doing things, and it's like a football, or it's like a soccer. So soccer is my favorite. So watch the soccer, what how they are playing. Same, I'm sure, football and other basketball, etc. So maybe you can learn something by watching soccer, where the ball is, where other players are, and what they are doing. So same way in trading, where what is going on. So you may get a black box. So you may have a black box just for the black box to give you green arrow and red arrow, and you trusting the black box. I used to have a black box, but it was all made up. That black box was a fake black box, and it was not a good black box. Maybe you find a good black box which give you proper entry and exit. So make sure you learn that black box. Make sure you ask the guy who created the black box, um, because when that guy is selling you the black box, he will say, look at all this trade, I made money. Then you ask him, hey, Mr. Black Box, under what market? What was the market condition? Can you give me the market condition, when the market condition was this black box? And what else? You know, is it fully automated, or what else went on? So the black box may not work for you. Maybe it's worked for him. Another way is to recognize, read the chart pattern. So this is what I do. I don't do band trading. Band trading, people do sideway market. When it goes above here, you short. When it goes go down and touch the lower line, you go long. I'm not that kind of trader. It's kind of boring. It's not for me. So there are some profitable trading which is not for you. So you just recognize it early on in your life that this is not for me. I can't trade band trading. I cannot trade black box. I need to know what is going on, some 100%. So if you're not, then don't do black box trading, don't do band trading. Maybe trend trader. You are a trend trader. So ask me, are you a trend trader? I am a trader. I need to follow the trend. So then you need to ask, I am a trend trader, but I always get in the trend when the trend is ending. So trend is not my friend. Trend is my enemy. I look at the strong trend, but when I get in, it reverses on me. So trend is not my friend, is my enemy. So I'm doing something wrong. So find out how to detect the change in the trend early on. Find out how to read the support and resistance. So this is very important. So support and resistance. So I am a support and resistance trader. When I see the stock bouncing from the support, or intraday reversal. So intraday reversal. So intraday reversal from the support. So if the stock breaks the support intraday and bounce back above the support, I am thrilled. So I have a process, and I'll show you sometime. I have a process, and if you are into duplicating success, you will see that process. So there is a process when the trade should be such that you should be excited. You should have a feeling inside your tummy, of a good feeling. So I get a good feeling when the stock breaks the support, and then by 12 noon Pacific, it's trading above the support. So that's my indication. I say, okay, yeah, I see it broke the support intraday, but then I waited patiently, and now it's trading above support. So maybe I don't go. Maybe I just buy 10 shares when I see that, just to dip. And I intend to buy, let's say, 500 shares. I just buy 10 shares. Okay, 10 shares is on my screen, is there as a reminder that I have some skin in the game. 10 shares of CRM, like that. Is still there. When I open my platform, I will see 10 shares. Maybe it's losing $10. So I know it's losing $10. So it's not the time for me to add more. But when it's up like $40, $50, then it's time for me to maybe buy more, because it broke the intraday support yesterday, and now it's bouncing up, and now it's moving up. So then I will go and buy 490 shares and make it total 500, or just leave it 10 shares over there, maybe just close it, take that $10 loss. So that's one way of intraday reversal. Breakout. So when I know if I have done my job of resistance reading correctly, so when I know this is a major resistance and the stock is trading just trading below the resistance. So when the stock is trading below the resistance, I'm if I hurry, because I lose my patience, I'll hurry and I say, oh, okay, I expect this stock to break the resistance. No, you may be wrong. And then if you're wrong, then you will lose. So you rather wait. And if you want, you can buy 10 shares. And if it breaks the resistance, you will have time to, because if the stock breaks the resistance, it's not just, okay, it broke the resistance and then it will fall. No, if it's a meaningful resistance and if it breaks, it will keep on going up and up. So your $10, 10 shares is making money, and then you can add 490 shares when it goes above resistance. But till then, just keep it 10 shares. So breakout of resistance, I I buy. If it breaks out and then touch the resistance again, test it and stay there. So then it gives me another opportunity to add, because the resistance has become a support. So I add another one. So scale in, scale out, breakdown. So I do the breakdown when it's breaking the support. Some kind of a support is being broken, or some kind of a resistance which was crossed before, and now the stock is falling below the resistance and falling. So breakdown is occurring. So breakdown is occurring either from the support or the resistance. Gap up. I love gap up. So when the stock gaps up, read, not all gap up are meaningful. So there has to be some meaning in the gap, and then where the gap is occurring. So this is where the traders miss out. They don't understand the whole landscape of a gap up, where the gap is occurring. Is it occurring at the initial stage, or is the middle of the stage, or at the top of the stage? So figure out what is the life cycle, where the trade is, and then figure out the gap occurring, whether it's occurring above the resistance or just below the resistance. What is the volume? What is the price action? Gap, is there a gap which is getting filled or about to be filled? Things like that. So gap up. If the stock gapped down yesterday and today it gapped up, so ask yourself, oh, the stock gapped down yesterday, now it's gapping up today. So if it's gapping up today, maybe there is a reason. There was a bad news, which is not a bad news. They just tripped, they thought it was a bad news, so it's gapped down. Now that bad news is no more bad news, it's a good news. So it's gapping up. I will go long. So you go long. There's no indicator. There's no indicator telling you that, hey, trader, yesterday it was gapped up, gapped down, today is gapping up, and here's the indicator. The indicator is that it gapped down and it gapped up. Window open, window close. So window open yesterday, today is gonna close. So go long. Worst come worst, it comes down and go below the gap down of yesterday. So you're out. Same phenomena for gap down. If it gap down, see what kind of market it has. If the market is bullish and the market gap down, you may be too late, because the market is bullish. There's a stock gap down. It will just fall a little bit and stay there, sideway move a little bit here there, and then you will find that the stock starts to recover. So you keep that stock instead of gapping down, buying puts or shorting. You put that stock on your watch list and stock it for reversal to the upside. So that's one. It is another technique, gap up reversal. When the stock gaps up, look at the gap up reversal. Where is it? Is it at the resistance, or is it below resistance, or where is the gap is occurring? Maybe it will reverse. I don't do gap up reversal, only gap up reversal. So gap up reversal we can do easily on a bearish market, on a downtrending market, when the stock gaps up, and then you can read it correctly. There is reversing this, and you identify your risk point and you buy the puts. So gap up reversal, gap down reversal, yes. So gap down reversal on a bullish market, on an uptrending market like Intel. So we did Intel gap down, and immediately at the gap down after 1 hour went long and closed our call position with a nice profit. So that gap down was just a gap down. Lasted only that day. Intraday reversal, I talked to you about. Moving averages breakout, I don't do moving averages breakout, but I keep an eye on the moving averages, but the 50-day, 220, simple moving average, exponential moving average. I take the volume of the moving averages and compare it, compare the 10-day simple moving average volume with the 10-day exponential moving average volume and see which one is higher, what's going on. It tells me if the volume today is higher than the previous day or whatnot. So this helps me in volume analysis also. So I do that. So all this goes on to find the trade. And then you need to put the filter. So you have a way of putting the filter. So you don't want to trade stock which is just 12,000. So I recently made a mistake, traded stock Sohu, and the volume was very low. So I came out alive, but the volume was very low. I said, okay, Sohu, I'm not going to trade you. You're out. So from my database, unless you improve, because there are 8,000 other stocks there. So I don't need to trade a stock which has 12,000 volume on any on even uh, 1 day out of 10. I don't want that kind of trade. So volume filter, price filter, maybe $15 and above or $20 and above if you want, if you're not trading small caps. Average true range filter, you want $3, $4, $5 filter, maybe average true range filter. Sudden spike in volume, if there is a spike in volume, I can look at it and see what else going on, but that's not the reason for me to trade. Sudden spike, 5,000% volume on 1 minute. If you look at this bar, there was a spike there. Somebody knows something. No, not somebody knows something. It just spiked. They did all kinds of a game. It spiked the volume. You should know what which they don't know. So don't be going after a spike in volume and then go and buy at the top. And then boom, 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 everything is crashing and you are stuck, a spike in volume, and you get the alert, spike in volume, buy 10,000 shares at 80 cents, and then it goes to 10 cents. So don't do that. Sudden move in price. So if sudden move in price, be patient. So I see, I put a filter that if the stock moves, let's say a 0.5% or 1% in 5-minute time interval or 15-minute time, tell me, knock at my door and tell me, yeah, I'm moving 1%. I moved in 15 minutes or 10 minutes. Take a look. And then I look and I say, oh yeah, you moving good. So let me figure it out, the entry point. I now know that you're moving, but I just need to figure it out, other things. So other thing is a big checklist. So I have a big checklist. I put that stock through the checklist. Where is the earning? What else is going on? Where is the support? Where is the volume? Do we have any position in it? Do we what else? So there's so many things. Check, 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 and then this entry price, entry point. Check all the options available, not available, good, volume, good, etc. So I'll show you the checklist of the option and whether we have a potential. Maybe it's spiking with the volume and the price, but it's too late in the game, so it's not good. I can't trade the stock which has been moving 5 days already, and today is the 6th day. Tomorrow it will die, because the 7-day move, suddenly the stock dies on you, and then you say, what? So don't do that. Alerts. So now you need to set all kinds of alerts. So it's up to you. Opening range breakout alert. So I define the opening range. If it's made a 15-minute high, I get the alert. If it made a 30-minute high, I get the alerts. I need to see which stock which I was looking in the morning is it still moving. So for instance, Airbnb. So Airbnb was moving early morning, and I put it on radar, and then I got the alert before the webinar that I need to look at Airbnb. So new intraday high being made, new intraday low being made. If it is moved up 1.5%, maybe 1%, I need to look at. If it went down, I need to look at. Volume is 30% of normal. So 30% of normal, and it's early age in the market. So it's only half an hour market has started, and it's already trading 30% of the normal volume. So normal volume, 10-day average, simple average, if it's straight 10 million on average on any given day, and it has already trading at 3 million in a 30-minute pass, So something is going on with this stock. That's why they start buying. So how do you rate different volumes? So I have developed the system of rating all the volume, relative volume, absolute volume, and the volume breakout. So you need to do all these filters and alerts: above average volume, high volume, below volume, breaking above resistance. If I draw the line on resistance and if it's crossing the resistance, I need to be notified. I need to be notified even if I am in the bathroom or I'm driving. I need to be notified that this stock is breaking the resistance. And then I also need to know if this stock is breaking the resistance, what kind of resistance? Is it a strong resistance? Is it extremely strong, like a China wall, and or is it just like a tennis ball resistance? So what kind of resistance it is, and what kind of position we have? Do we have a position? Yes. It's breaking the resistance with the volume. What volume we have? This. Okay, how many days left in the trading? Oh, only 2 days left to expiry. Oh my goodness, this we have to sell. Only 2 days left in the, or I'm holding this position for 21 days, and finally is breaking the resistance. So finally is breaking the resistance, but I've been holding it for 21 days. Maybe I need to sell that that stock. I'm holding it for 21 days, so resistance is broken. Tomorrow it can come down to resistance, below resistance. So breaking below support. So if I have a position long and I define a support which is very strong and it's breaking the support, so this is not right. What else is wrong over there? So if one evidence is wrong, then I need to figure out the 9 other evidence. So I check other evidences. If one major evidence is wrong, then I look at all the other evidences and I say, okay, this is not working. What else is not working? So maybe there are little evidences. They are like, one big dog, and then you have a 9 little dog. So just think like this. You are living in a ranch and you have a one big dog and he does the job. He goes and bark and alert you. But most of the time he just alerts you wrongly. He wakes you up and then you say, hey dog, why I know you're a big boy. You bark too much, so don't bark. So he kind of get disappointed with you because he is barking and then you are telling him not to bark. And then you have 9 little dogs and they are just sitting there. They are just not doing anything, but then they also start to bark little by little. So now they are little dogs, Chihuahua. So you start paying attention. Not only my big dog is barking, these small little dogs are also barking. So I need to look at these. There must be something. So you go and look at all the other evidences, whether they are small or big, and come to the conclusion whether you need to hold that trade or exit. So think about that. Sharp reversal from resistance. So sometimes the stock just goes hit the resistance and then it start falling. So what is going on? Why is falling? Resistance means sellers. So sellers were there. Is there a genuine reason they are just selling their inventory, or there's some? It so happened that when the stock is hitting the resistance, some news also gets delivered from somebody. So remember, the news is delivered to us intentionally at some key points. So whether the government or whether the private people, they do deliver the news intentionally at the key. If I'm a big boy and I have a news, and I know all the traders are stuck there buying and selling, and I have a big news, I make sure I clear everything, right? My position and everything, and then I will release the news. It's like I just say to my hitman, hey hitman, release this news now. And he goes and release the news uh, to the press and say, okay, this is what's happening. And then all traders, they just start selling. So, and I'm already out. So think about that. Same thing, sharp reversal from support, crossing moving average from below, and crossing moving average from above. So these, traders look at the crossing moving average when the trade is going above the 50-day moving average from below, or crossing above from above below the moving average. So if you know that they are watching, so wisdom of the crowd, if they are watching, then something will happen. Maybe it's a temporary thing. So if your other little dog, they are not giving you any confirmation, maybe you hold on to the trade and take advantage of this moving average cross. Your moving average is just a line, a moving average. I mean, what is there? Moving average. Who says 50-day moving average is the the signal? Why not 51? Or it might as well be 49 or 53. So it's just made up numbers. 50-day moving average, 200-day moving average. So these are all made up numbers, and we need to be aware of. So all these alerts you need to have. Now comes, let's say after you go through all this and you find your trade and you say, okay, I need to buy this option. So quickly you will go through some checklists. So the first checklist is, first thing you need to look at when selecting the options is, where is the target? So you ask yourself, where is my target? So the target will tell you where the options, uh, what kind of options you need to select: in the money, out of the money, at the money, etc. You need to know. So if the stock is trading at 100, then you say, okay, the stock is trading at 100 and target is, let's say, 110. So if the target is 110 and the stock is trading at 100 and it's trading in a very nice way, a nice volume, big news, and everything is good, and so you may go buy at the money calls at the projected target, which is 110. Maybe you don't want to buy 110, you may buy 105 strike. So when the stock is trading above 105, like let's say 108, 109, 110, you are already in the money, and your option is moving faster once it's crossed the strike price. So look at all the projected target you have: green, yellow, and red. So I have three targets. I define green and yellow and red. So most of the time, if I look at the yellow target, which is the middle target, the second target. So when the second target is hitting, if I'm going out of the money, when the second target yellow is hitting, I'm in the money. So I know I'll be fine. Or I can look at the stop price. So if I'm buying, let's say I'm buying a stock option trading at 100, it's trading at 100, and my stop is, let's say, 95. So so if I buy 105 and it goes to 95 stop, I will lose a lot of premium in my option. So I don't want to do that. So maybe I buy a 95 strike in the money. So at 95 strike, I'm buying. If the stock goes down and hit my 95 stop, which is a support level, it's not the stop, it's it's a support, and which is where I will make some decision whether to hold or not. So I may buy 95 strike in the money. So I can do that. Now, another thing we need to pay attention to, the current price and the strike relationship. So people, I'm not sure if you look at it, but I look at it: current price and strike relationship. So I give you example. So let's say the stock is trading at 72 and the strike is available 70 and 75. So strike is 70 and 75, and strike is and the stock is trading at 72. So let's say the stock is trading at 72 and the strikes available are 70 and 75. So if you select 75, you're selecting out of the money. So your stock is trading at 72, and if you select 75, and if that's the target, only 3 points, then you're selecting out of the money. So you may think about buying 70 strike. So you are in the money. And if the strike of 72.50 is available, then you may buy 72.50 because it's just 50 cents out of the money. So it depends if where the stock is and what kind of strikes are available, how far from your current price, and what is the closest in the money strike. And there may not be much difference between 70 and 72.50 or 72 and 50 and 75 in terms of premium. So think about this, whether to buy out of the money or in the money. When you are stuck in the middle, your stock price is in the middle of your um, two strikes. Also, some you want to buy some strike, but the spread is huge over there, and some strikes have a little spread or minor spread. That's where the activity is going on. So the spread is normal. So pay attention to the spread. Maybe you don't want to buy out of the money. Maybe it has a higher strike, or maybe the strike you're choosing has a normal than average spread, because as soon as you open a position, you lose money. The option game is designed that way. As soon as you go long or you open a position, you lose money in option. Suddenly you're losing. And the reason you're losing is because the spread. If the spread is wider, the thing you bought for $10, you turn around and you want to sell, you can sell, but it's trading at 950. You can only sell at 950. And if the stock goes against you, then it's trading at 9. So you bought at 10 minutes later, it's at 9. And then traders put 10% stop in option, and then they get stopped out. And then they say, option trading is not working for me. It will not work for you, because there is a spread and there is a slippage, and then the stock is volatile. It just doesn't go straight, start moving as soon as you buy and you say, okay, I bought it, now let's go. It's not going to happen. It doesn't happen only sometime. So that's anomaly. So try to shave the spread. Try to focus on those options where the spread is narrower. But if you find all the strikes have a bigger spread, and you decide not to, but the stock is looking good, maybe you buy 100 shares. So maybe buy 10 shares. So you don't have to buy options. You can buy stock. If you have the money, you can trade a stock. And if the spread is also, if the spread is wider, sometimes there is a reason for the spread to be wide, because there's some unexpected, some event is coming. Some event is coming, and the spread is, and the traders are in a hurry to buy. So that could be the reason. So don't ignore something which has a wider spread. And just because it's a wider spread, there may be some reason. That's why it has a wider spread. If the market opened early morning, 50, and only 10 minutes gone by, and the spread is huge, then the market maker is trying to cover his books, because he don't want to lose money. He goes, at the end of the day, he has to go home with making the money. He then has invested, too much money in the stock business, so he needs to go home. So he needs to make sure that whether the ask is high, if somebody wants to buy, he raise, or the bid is lower. So he does his thing. So wait for 15, 20, 30 minutes. You don't have to trade. If you're in the trade already, you just calm down and figure it out. The spread is normal, then you sell. The volume. So option volume, if there is no volume, maybe you are the only one out there. So when you go to sell, maybe then you will be the only one selling and nobody is buying. So pay attention to the volume. Sometimes I ignore the volume. If not there, it's not there, maybe 10, 15, 20, because I'm basing my, as long as I know that I'm not getting fooled with the option price, I'm expecting the stock is looking good. So the stock is, I'm trading a stock. So if the stock is telling me that this is, I need to trade. So even if the volume is low, I go for it, as long as the spread is normal and the option prices are normal based on the theoretical value. So based on the theoretical value of the option and what is the ask price. So it's not inflated. So I do that. Open interest, there's another thing which is not mentioned here, open interest. So look at the open interest. The higher the open interest is better. So pay attention to the open interest. The market conditions, this is where traders ignore, that they are not flexible. So depending on the market condition, you also choose your strike price. If the market is bullish and the trending upward, then when you buy out of the money calls, let's say your market is uptrending and you're buying out of the money calls, it will give you the most bang for the buck. Where out of the money will become in the money, and your rate of return will be higher because the market is uptrending. So market is uptrending and everything is moving nice and nice, nice, nice. So you're not losing the time, the time decay is not kicking in as fast. So if the market condition is suitable for that kind of trade, whether up or down, then you may go for out of the money calls or out of the money puts. But if the market condition is choppy, so you need to know when the market condition is choppy or is stuck or is getting into consolidation. So you need to pay as little as for the time decay and buy in the money call. So again, another thing, you need to pay attention to the market condition. You may be buying extra time. Maybe instead of buying April calls, if the May calls are available, you buy May calls because the market is stuck. Maybe you have some open position and you say, okay, I have March open position. I cannot be buying March position, any March calls because I already have March. So I have a quota for March, and I need to spread my risk to April or May. So I will be buying the strike or calls or puts or whatever for the next month, May or June or April, but not March because I already have these March positions. So analyze your open position and see what you have, how much dollar you have invested, and analyze the market conditions, and then analyze the target and analyze where the current price is, where the strike is, in between, where the spread is, volume is, whether you're overpaying, underpaying, all that. Then you decide what options to select. So looking at option data, current price of a stock versus the strike price. I gave you this explanation. I gave you in the money, whether to buy in the money or out of the money or at the money. Compare your price of option with the theoretical value of ask. Option spread, you need to make sure option spread is normal. Some options have only 1 cent, 2 cent spread. They are so liquid. Some have 5 cent spread, some have 10. It's not the dollar amount, is the percentage. So a 50 cents option, if you're buying a 50-cent option and the spread is 5 cents, that's too much compared to if you are buying option at 1 and the bid is still 5 cents. So compare, it's not the dollar, 5 cents is the percentage between the difference between ask and bid. So look at that. Option open interest, look at it. Option volume, look at it. Implied volatility, if the implied volatility is high, the options prices are inflated. So keep an eye on the implied volatility. If the volatility goes down, your option price will go down and the stock moves up, but you don't make money. So you got caught with the volatility. Make sure you're buying standard options. If you're buying non-standard options are just, when the stock is split or dividend or something happened, they create a non-standard options. So they are valid only, like you see $12.33 strike. That's when you see this kind of thing, then this is a non-standard option, and they just created it temporarily for the event which occurred, and you may want to avoid non-standard options. Only trade the standard option. This is where all the big boys are trading. So you want to stay where the big boys are, where the liquidity is. Don't go into non-standard. If you go, you must have a reason. Look at it. If non-standard, they expire. They are only valid for next month or so, and then that's it. They are gone. You won't see continuous non-standard options. So just make sure you understand non-standard options. Now, when you are selecting option, you also need to look at where is the target. So these three key things are four key things. The target, based on the target, you're selecting your option based on where the support is. So if the stock pulls back to the support, you're still in the money or at the money. You're not going way out of the money, because once you go way out of the money, then when you're crawling up, it's hard. The option is, it's like the car is already dying, and then you are putting pushing the pedal, and you're making the car go to the Mount Everest, and it's having a hard time compared to a little pullback, and the car still has a power, and then when you put the gas, it goes up, and then it starts flying. So it's better when the stock pulls back, it pulls back to your strike or not. I mean, this is what I learned. Nobody taught me. I don't know if this thing is written in any book, but over the experience, when the stock pulls back, it pulls back to my strike. Ideally, it shouldn't go below the strikes because that's where the support is. So try to figure it out. What is your support? And then see, is there a strike price close to the support? That's what I need to buy. And same thing for resistance. So resistance, if the stock has a resistance, then maybe you want to buy. If you're buying out of the money, maybe that's the strike you buy and say, okay, if the resistance is at 105 and the stock is trading at 101, I can buy 105 strike, because when I buy 105 strike and it goes and hit, my calls will become at the money. That's where the premium is, and I will sell. So my strike price will match the resistance price, and I'm out. So analyze resistance, analyze the strike, analyze the support, analyze the strike, analyze all the targets, and compare with the strike. See what is making sense. And also, when you rolling your trade, so maybe once when one target hit, you're at the money, you close that strike and then roll to the next strike. So if you have a, let's say you bought 100, you bought something 105 strike. The stock is trading at 100. When the stock hits 105, you sell that 105, and then you say, okay, now I will roll to 110. So you go and buy 110. You sold your 105 strike and you bought 110 because the stock is still moving. So as long as you're not losing money on the spread, etc., you do that analysis, roll your strike. Another thing you need to pay attention, if there is an earning event coming up. So always before you put on the trade, there's a checklist for earning. Check the earning. Where is the earning? Oh, earning tomorrow. Okay, earning tomorrow. So I'm buying this. What if I get clobbered? So if I buy 2-week expiry, earning tomorrow, and if earning goes against me and the stock drops, then my option will go to zero, first of all. Then I only have 12 days left, so I will not be able to recover. So I might as well go to Vegas and put this money on some machine. So I may do that, or I figure it out. I say, okay, earning coming up, so earning is tomorrow or day after tomorrow. I better buy 40, $45, 40, 45 days in time. If I know some odds are in my favor of earning and I still want to trade, then so I trade earnings. So when I'm doing the earning analysis, I'm doing all this. So I'm saying, okay, I need to buy enough time, 45 days. Then when the earning comes and it goes against me, where it will drop. So is there a support? Somewhere support, like 5-7 points. Okay, it has a support. So if earning comes bad, it may fall, but it will fall 5-7 days. And then I'm planning my game. So you plan your game before you go to the battle. So you say, okay, I'm playing my game. If it falls, it will fall to this support expected. And then I have 45 days. And then my option will be 50% haircut. And then I will manage and I'll go and add more to it, dollar cost averaging. I do that, and then I'll be alive and I'll make money. So if all this planning is telling me still go with the earning, then I go for it. So, or sometimes you just take a flyer, 50 cents, option expiring 2 days later, you know, it moved $10. It's a Tesla, and I can buy. I don't think you can buy 50-cent option on Tesla, but if you can, maybe $1. So if you buy and you say, okay, Tesla moved 20 points earning, my $1 option will go to $10. Otherwise, I lose $1. So that is a good bet. You can do all day long, and if you are right 50% of the time, you can become rich. So maybe that's the thing you can do. Another event is FOMC event. So you don't want to, if you're buying options, if you can look at the FOMC, if FOMC event is coming closer, so the stock market just gets stuck. It doesn't move. They're expecting for the announcement and all that. So if you say, okay, if this announcement will come and I will get stuck, so I decide whether to buy the option expiring before the option, I don't need to pay, or I need to survive this event and I go beyond this event. I buy the time beyond this event, so I will survive. Product announcement coming, so if you know the product announcement, so you can buy, if some kind of product announcement is coming from pharma or something, you can buy out of the money calls. um, so you don't pay too much, and then if the announcement is positive, you're expecting, you make money. Some government announcement coming, you need to decide your options based on some key government announcement coming beyond the event date. So if you think that you will get stuck in one of these event or any other event, you need to have enough time beyond the event. So if I draw the graph, so maybe I draw the graph and I draw a graph, a line, a timeline. If I draw the timeline graph and I put these even on a horizontal line, my expiry date is way beyond on the right side of the event. So the right side of the event, enough time for me to survive and manage these trades. So think about that. Another thing, when you're trading options, of course, you're trading options based on your decision on the market, what kind of market you have, whether the up market or a down market or sideways market or momentum market. When there's a momentum market, then everybody is a genius. So I'm not genius, you're not genius. Even monkey is genius when the momentum is there and the market is moving. Everybody is genius, everybody is trading. So if the momentum is there, you buy out the money calls or out of the money puts, so you will make a lot of money. But if it's a sideways market, you need to realize, maybe you stay away from the market, you go in cash or lower your exposure. If it's an up market, down market, then you need to how strong is the strength. If the strength is there, out of the market will work. If the strength is not there, you need to buy in the money uh, calls or in the money. If the down market with no strength is just lingering, you need to buy some time for your position to work. Sometimes in the if it's a put, let's say I'm buying a put. I give you example. If I'm buying a put and I'm very confident that this stock has topped out and is just doing its thing, up and down and up and down, and eventually it will crash. So I buy in the money puts. So I save my time decay, I let the market do its thing, and eventually it's crash, and that put will uh, gain a lot compared to out of the money put I buy, and then even I'm right 10 days later, but then nothing happened to my puts because all the premium is gone. Unless the market tank next day, my out of the money put will make a lot of money. But in the money put, I buy, and or unless the stock moves 20 points, 30 points, then I'm buying some out of the money put. So when the stock tank 25 points and I'm 10 points away, I immediately get in the money. So all these um, points go when we are selecting the options. Another thing, averaging down or averaging up. So when you are averaging, traders make mistake when they are averaging down and they don't want to average up. So traders don't, maybe they're not doing averaging up, they do averaging down. But then we hear the news, don't average down, never, 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 ever average down, you're losing position. So they say like that. I have prepared a chart. I prepared a Excel-like worksheet, and I will show you that uh, a fortune is made when you have a plan and your plan is working when you are doing averaging down. The fortune is made in averaging down at the key points, especially if you are a long-term trader. So on a short-term trader, you have to be very agile in your averaging down. For if you're a long-term trader, the fortune is made in averaging down. Significant difference. So I prepared a slide chart. I'll show you through the numbers. So for option trading, when you averaging down, then when you say, okay, I'm losing in this position, okay, I bought VLO, my goodness, I bought VLO, and then the news comes, and then it is going down. So I start receiving message, hey, what did you see in the chart? Why did you send me this trade VLO call? And I'm losing money. I'm losing 1,200. I'm now losing another 350. Hey, like that kind of email coming at me, and then I'm, hey, calm down, Steve. Just calm down. This is a support. So eventually, so I know VLO. Sometimes it happens. This is the worst trade when you enter and you get up, you go take your dog for a walk, or you go make. I don't have a dog, so I go make a coffee, and I go make my coffee and come back and I see that. So this hardly happen, but it can happen, and it happened in VLO trade. So VLO immediately start. So now I had to come up with the plan. First of all, okay, where is the support? So I knew that it's 127. So I said, okay, intraday it will dip 127. Then what I will do when it goes down to 127 and it starts to bounce. So I have a different strategy to not only survive but make some serious money. So I can if I bought a 135 strike and the VLO is trading at 127, then I am 8 points away from the strike. So I'm 8 points away. So but then I have a time, and then if I see VLO is reversing sharply, and all the other stocks are reversing after 2, 3, 4 days of a pullback. Because all the oil stock, they just go together and come back up. So same strike in same month. So I had a choice of buying the same strike 135 and the same month, or I can say, okay, I already have 135 strike. VLO is 120. It hit 127. Now it's 129 or 130. I buy 130 strike besides having 135. So I buy 135, and same month, maybe I can buy March, or I can buy 130 strike and April month if April is available. So I mixed and matched. So I have a 135 strike. The assumption is that this support will hold. Otherwise, I'm putting bad stuff over the good stuff over the bad. So, good money over the bad money. So if you know that this is support and this price action is really happening the way you think it should happen at the support, and not only this stock is moving, but other stocks are moving. The crude is moving. So if when you put 2 plus 2 together, you get 5. So 5, you say, okay, I can buy some 135 strike to lower my average, but I buy 130 strike in April month. So combine all that, become a basket. So when the oil VLO crosses 135 and goes at my break even, the original position, and the new position is making me money, 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 and I keep adding little by little, little by little, here, there, every day there's a confirmation, and finally everything dumped VLO and make a lot of money. So averaging down willy-nilly is not good. I receive email saying, hey, I'm down in this position. Should I average now? No, please wait. Just because you want to average down, you're not a long-term trader. So if you're a long-term trader, your average down doesn't have a technical criteria. Your average down is when you get some paycheck, leftover money, you send it to your broker, and he will buy some more units of that mutual fund, and you average down. But when you are a short-term trader, you don't average down just for average down. You need to average down at a proper price point, because you don't have time, and you're trading short time. So maybe if you're a long-term trader, you just close your eyes and tell your broker, hey broker, just buy me 100 more shares. I got the money from my salary. So don't do that. When you're a technical trader, you need to analyze and then find the time to buy, and then analyze the strike and the month. So this is what I do when I'm selecting the options to trade. And if you have any questions, please let me know through email. You have my email, the success@tradegenie.com, and I'll see you next week. Okay, thank you.